Progress, and I believe this is. This week's paper is How Active is Your Fund Manager? Progress, and I believe this is. A new measure that predicts performance by Martijn, Cremers, and Antti Petajisto. I believe this is. Published in the Review of Financial Studies in 2009. Progress, and I believe this is. The thesis is deceptively simple. Most performance attribution focuses on how much risk a fund takes relative to a benchmark. Progress, and I believe this is. This paper asks something different. How different is the portfolio from the benchmark stock by stock? Progress, and I believe this is. That question produces a measure called active share. Progress, and I believe this is. And the paper's claim is that active share predicts which actively managed funds will outperform their benchmarks after fees. Progress, and I believe this is. Here's why it matters for your portfolio if the result holds. Progress, and I believe this is. You have a low-cost screening tool to separate genuine stock pickers from closet indexers charging active fees for passive like exposure. By the time Cremers and Petajisto's paper appeared in 2009, the empirical literature had reached a rough consensus. Progress, and I believe this is. Active mutual funds on average underperformed passive benchmarks after fees. The FAMA French evidence, Carhart's four-factor model. Progress, and I believe this is. Jensen's alpha studies. The cumulative weight of the research said picking stocks was a negative sum game after cost. But the authors suspected the problem was averaging. Progress, and I believe this is. Saying active funds underperform on average tells you nothing about whether the return distribution has meaningful winners. Progress, and I believe this is. It could be that most active funds are closet indexers dragging the average down. Progress, and I believe this is. While a genuine minority of concentrated stock pickers actually add value. Progress, and I believe this is. The paper's central question is there a measurable portfolio characteristic that identifies those two groups before the fact? Progress, and I believe this is. Not ex post alpha, which you can only observe after the returns have come in. Progress, and I believe this is. Something structural about how the portfolio is constructed that correlates with future performance. And I believe this is. Active share is their proposed answer. Progress, and I believe this is. Active share is defined as half the sum of the absolute differences between each stock's weight in the fund's portfolio and its weight in the benchmark index. Progress, and I believe this is. In practice, if you hold the same stocks in the same proportions as the S&P 500, your active share is 0. Progress, and I believe this is. If none of your holdings overlap with the benchmark at all, active share is 100%. Progress, and I believe this is. Most actively managed funds sit somewhere in the range of 60 to 95%. Progress, and I believe this is. The key conceptual move is separating active share from tracking error. Progress, and I believe this is. Tracking error measures return volatility relative to the benchmark. Progress, and I believe this is. You can generate high tracking error from a single large factor bet, going heavily underweight duration. Progress, and I believe this is. Or overweighting small cap momentum, without deviating much from the index at the individual stock level. Progress, and I believe this is. Active share is insensitive to those factor tilts and sensitive only to stock by stock portfolio composition. Progress, and I believe this is. That separation lets the paper construct a two-dimensional taxonomy of active management styles that tracking error alone cannot distinguish. Progress, and I believe this is. Plotting funds on active share versus tracking error produces 4 quadrants. Progress, I believe this is. High active share with low tracking error. I believe this is. Concentrated stock pickers, managers who hold a focused portfolio of individual names without large systematic factor exposures. Progress, and I believe this is. These are funds where stock selection is doing most of the work. And I believe this is. High active share with high tracking error. Progress, and I believe this is. Funds making both stock level bets and large factor tilts. The paper sometimes calls these diversified stock pickers. Progress, and I believe this is. Low active share with high tracking error, pure factor bettors. Progress, and I believe this is. Funds making systematic sector or style rotation bets without doing much differentiation at the individual stock level. Progress, and I believe this is. And the 4th quadrant, low active share with low tracking error closet indexers. Progress, and I believe this is. funds that hug the benchmark closely in both holdings and return volatility while charging active management fees. Progress, and I believe this is, the closet indexer bucket is where the paper's implicit critique of the fund industry lands hardest. Progress, and I believe this is, if your active share is 60% and your tracking error is 3%, progress, and I believe this is, you are selling active management and delivering something very close to a passive index fund at active prices. Progress, and I believe this is, the paper does not accuse fund managers of deception, but it does quantify how common this pattern was in the sample. Progress, and I believe this is, the paper's main empirical result is that active share positively predicts subsequent benchmark adjusted returns. Progress, and I believe this is, concentrated stock pickers, the high active share, low tracking error group outperformed. Closet indexers underperformed. Progress, and I believe this is, the outperformance for the concentrated stock picking group is reported by the authors as statistically significant and, on a risk-adjusted basis, progress, and I believe this is, on the order of roughly 1 percentage point per year. I want to be explicit that I am hedging that number. Progress, and I believe this is, not asserting a specific coefficient. The estimate varies by benchmark attribution method and regression specification. Progress, and I believe this is, and you should consult the paper for the full table. Progress, and I believe this is, what the authors establish is that active share adds predictive information not already captured by tracking error. Progress, and I believe this is, when both variables are run together, active share retains statistical significance. Progress, and I believe this is, tracking error alone does not predict outperformance in the same way. Progress, I believe this is, the result holds after controlling for fund size, expense ratio, fund age, and turnover. The core claim meaningful. Progress, and I believe this is, concentrated deviation from the benchmark in the stock picking style rather than the factor bet style correlates with future alpha. Progress, and I believe this is, the paper addresses the most pressing alternative explanations. Progress, and I believe this is, the most important concern is benchmark misassignment. Progress, and I believe this is, a mid-cap fund measured against the S&P 500 will mechanically show high active share because its holdings do not overlap with the large cap index. That is not active management. It is benchmark mismatch. Progress, and I believe this is, the authors handle this by assigning each fund to the benchmark that minimizes its active share. Progress, and I believe this is, which they treat as the most appropriate benchmark and show the predictive result survives that matching. Progress, and I believe this is, they also test whether active share is proxying for fund size, and I believe this is, smaller funds tend to be more concentrated. Progress, and I believe this is, smaller funds in the sample period also earned higher returns due to size and liquidity effects. Progress, and I believe this is, the paper reports the active share result is robust to controlling for fund size. Progress, and I believe this is, expense ratio is a separate check. If high active share funds happen to charge lower fees, the outperformance is a fee story, not a skill story, and I believe this is, the paper controls for this as well. Progress, and I believe this is, the sample period, spanning roughly 2 decades ending in the early 2000s, is a caveat the robustness tests do not and cannot address. I believe this is, out of sample validity is the paper's open question. Progress, and I believe this is, the Cremers Petajisto finding attracted significant subsequent scrutiny, and I want to give the challenges their proper weight. Progress, and I believe this is, the most pointed rebuttal I am aware of came from a paper by Frazzini, Friedman. Progress, and I believe this is, and Pomorsky. I believe this appeared in the Financial Analyst Journal in the mid-2010s. Progress, and I believe this is, though I would verify the exact citation before relying on it in a research context. Progress, and I believe this is, their argument as I read it is that the active share premium was concentrated in small cap benchmark environments. Progress, and I believe this is, small cap funds mechanically show higher active share against large cap heavy indices. Progress, and I believe this is, and the small cap return premium in the original sample period is doing significant work that the authors did not fully account for. Progress, and I believe this is, when funds are properly assigned to benchmarks that reflect their actual investment universes. Progress, and I believe this is, The outperformance attenuates considerably by their account. Progress, and I believe this is, Cremers has responded to these critiques and updated evidence in subsequent work. The debate is live. Progress, and I believe this is, there is also a structural concern that no study can easily resolve. Progress, and I believe this is, if active share became a widely used institutional screening criterion after 2009, and it did, then demand for high active share funds may have bid away the return advantage. Progress, and I believe this is, the predictive value of a signal that everyone monitors looks different than the predictive value of one that was still unobserved. Progress, and I believe this is, 3 takeaways, and I will distinguish the paper's conclusions from my own read. Progress, and I believe this is, the paper concludes active share significantly predicts subsequent benchmark adjusted performance. Progress, and I believe this is, concentrated stock pickers outperform, closet indexers do not earn active fees. Progress, and I believe this is, that is the claim. My read, the practical screening use survives even if you are skeptical of the predictive coefficient. Progress, and I believe this is, asking a fund for its active share forces a quantitative answer to the question of how different this manager is from the index you could buy for a few basis points. Progress, and I believe this is, that is a legitimate due diligence question regardless of whether the alpha forecast holds out of sample. Progress, and I believe this is, it filters out funds that are hiding behind a benchmark at active management prices. That filter seems worth running. Progress, and I believe this is, a separate caveat active share identifies something necessary but not sufficient for skill. Progress, and I believe this is, 2 funds can share the same active share, one concentrated in high conviction fundamental names. Progress, and I believe this is, one in speculative microcap positions with high turnover. Progress, and I believe this is, the measure does not distinguish. It tells you the manager is doing something. Progress, and I believe this is, it cannot tell you whether that something is skilled or not. Progress, and I believe this is, what would change my read on this? A rigorous, properly benchmarked progress, and I believe this is out of sample study covering post-2010 data showing that concentrated stock pickers still outperform net of fees after active share became widely monitored as a screening criterion. Progress, and I believe this is, that evidence would substantially settle the question of whether the signal survived its own institutionalization. And I believe this is, absent it, treat the taxonomy as useful vocabulary and the alpha forecast as genuinely contested. Progress, and I believe this is, that is the honest position, that's the paper. Progress, and I believe this is, the review of financial studies link is in the description. Progress, and I believe this is, next week I will read another, not investment advice, just a careful read.